Warren Buffett has built an empire, founded on the principles of value investing, patience, and a deep understanding of businesses and the economy. As one of the world's most successful investors, his approach has become the benchmark for how people around the globe think about money and wealth creation. For decades, Warren Buffett's decisions were seen as almost infallible, as if the very nature of his investment choices was a guarantee of success. However, as the global economic and financial landscape continues to shift dramatically, one must ask the question: can the principles that Buffett's empire was built on continue to endure? Is Buffett's strategy, developed over decades of research, observation, and experience, still relevant today? As we witness an acceleration of digital technologies, changing consumer behaviors, and new market dynamics, Buffett's empire is not immune to challenges. The tools that once fueled his success, the long-term value investing philosophy, are under increasing strain. The advent of new technologies such as blockchain and artificial intelligence, the disruptive forces of cryptocurrencies, and the rise of unconventional investing methods such as meme stocks are pushing investors to rethink traditional approaches. These forces are not only testing Buffett's investment strategies, but are also forcing him to grapple with questions about the future of finance. We'll explore the potential collapse of Buffett's empire and the shifting dynamics that could render his investment style obsolete. We'll explore the intersection of tradition and innovation and see whether the Oracle of Omaha's way of investing will stand the test of time. This is Warren Buffett, the collapse that will change a generation. Number 1. The genesis of a legend. Warren Buffett's path to financial success is a remarkable one, shaped by a combination of fortuitous opportunities and an exceptional ability to understand and predict market behaviors. His story begins in the midst of the Great Depression, where the seeds of his future success were planted. Born in 1930 in Omaha, Nebraska, Buffett's upbringing during a time of economic instability would later influence his approach to money. His father, Howard Buffett, a congressman and stockbroker, was a significant influence on him, providing Buffett with a front-row seat to the intricacies of the stock market at a young age. Buffett's early experiences with business included selling chewing gum, Coca-Cola, and magazines door-to-door. As a young boy, he already had an entrepreneurial spirit and a keen understanding of the value of hard work. However, it was his love for numbers, statistics, and patterns that led him to the world of investing. Buffett's intellectual curiosity and his ability to find value in the world around him would later define his investing philosophy. The defining moment in Buffett's career came when he encountered the teachings of Benjamin Graham, the father of value investing. Graham's book, The Intelligent Investor, was a game-changer for Buffett. The core of Graham's philosophy, which Buffett would come to adopt, was the idea that stocks should be seen as pieces of businesses, not as trading commodities. By focusing on businesses with strong fundamentals, companies that had a competitive edge and were trading below their intrinsic value, investors could achieve long-term, consistent profits. Buffett took this philosophy to heart and began applying it in his own investments. He started by purchasing shares of companies that had a long history of success and were undervalued by the market. In 1965, Buffett took control of Berkshire Hathaway, a struggling textile manufacturer, and turned it into his primary investment vehicle. Over the next few decades, he transformed Berkshire Hathaway into a massive conglomerate, acquiring a diverse range of businesses including insurance companies, utilities, and consumer products. Each of these businesses was selected using Buffett's rigorous value investing criteria. Berkshire Hathaway's success was built on Buffett's insistence on holding on to investments for the long term. Unlike many investors who sought to profit from short-term market fluctuations, Buffett's focus was on purchasing high-quality businesses at fair prices and holding on to them for years, if not decades. This strategy proved successful, and Buffett became a household name. His investment acumen, combined with his folksy, down-to-earth demeanor, made him an icon in the world of finance. His annual letters to shareholders became a goldmine of investing wisdom, and investors everywhere began to emulate his approach. However, even the most successful strategies face challenges. As we enter a new era in finance, Buffett's traditional methods are increasingly being tested by forces that weren't as prominent during his early years. The market is evolving rapidly, and the strategies that once fueled Buffett's success may no longer be as effective in today's fast-paced, technology-driven economy. Number 2, the new rules of the market. The financial markets of today are vastly different from the markets of Buffett's early years. The rapid advancement of technology and digital transformation has introduced a new set of tools and methods that are reshaping the way investors approach the stock market. For decades, Buffett has relied on traditional methods of valuation, focusing on fundamentals such as earnings, competitive advantages, and the quality of management. This strategy allowed him to build a portfolio that consistently outperformed the market. However, the rise of technology and the increasing influence of data science have dramatically changed the game. High-frequency trading, HFT, powered by algorithms and artificial intelligence, has transformed how stocks are traded. In the past, investors made decisions based on company reports, earnings projections, and market trends. Today, machines make split-second decisions based on a multitude of factors that humans can barely comprehend. Moreover, the democratization of investing has been one of the most significant changes in recent years. Platforms like Robinhood and eToro have given retail investors unprecedented access to the stock market. This has led to a surge of new traders, many of whom lack experience or the traditional knowledge that Buffett espouses. While Buffett's strategy emphasized the importance of long-term investments in quality companies, today's retail investors are increasingly focusing on short-term gains, often driven by social media trends or online forums. The rise of meme stocks, such as GameStop and AMC, is a perfect example of how retail investors can drive massive volatility in the market. These stocks are often propelled by social media posts, influencers, and groupthink rather than any fundamental analysis. While this kind of speculative trading is at odds with Buffett's philosophy, it has become a dominant force in today's market. The power of collective action among retail investors has shown that the market is no longer solely driven by institutional investors or long-term, value-based decisions. Instead, it has become a space where sentiment and emotions can drive market prices in ways that were previously unimaginable. In addition to this, the rise of cryptocurrencies presents a direct challenge to Buffett's traditional view of money. Buffett has famously criticized Bitcoin, calling it rat poison squared and dismissing it as a speculative bubble. However, the increasing acceptance of cryptocurrencies by institutional investors, governments, and large corporations suggests that digital currencies may play a more significant role in the financial system in the future. The decentralized nature of cryptocurrencies, combined with the potential for blockchain technology to revolutionize various industries, is something that Buffett's traditional, conservative approach to investing does not embrace. The changing dynamics in the market mean that the traditional tools and methods of analysis may no longer provide the same advantages that they once did. The speed of trading, the rise of digital assets, and the influence of retail investors all suggest that the rules of the game have shifted. And this is where Buffett's empire faces a significant test. Can a traditional value investor, whose methods have been so successful in the past, continue to thrive in a market driven by technology, speed, and mass sentiment? Number 3, the vulnerabilities in Berkshire Hathaway. While Buffett's investment philosophy has been a source of remarkable success, Berkshire Hathaway's portfolio is not immune to the challenges presented by the modern market. One of the biggest concerns is the concentration of its investments in a few key sectors, particularly its large stake in Apple. Apple has been a phenomenal performer, and Buffett has publicly stated that he sees it as a company with an enduring competitive advantage. However, with such a large portion of Berkshire's portfolio tied to a single stock, there is a significant risk if Apple's performance falters. Apple's dominance in the tech industry is impressive, but the company is not immune to the forces of disruption that are rapidly changing the tech landscape. The smartphone market, which has been Apple's cash cow for over a decade, is facing saturation. Consumers are holding on to their devices for longer, and growth is slowing. Moreover, Apple faces intense competition from other tech giants, particularly Google and Samsung, and new entrants to the market are challenging Apple's position. Furthermore, Buffett's large investments in traditional industries, such as insurance and railroads, may also face increasing pressure in the years to come. The insurance industry, while still profitable, is increasingly threatened by the rise of insurtech startups. These tech-driven companies are leveraging big data, machine learning, and artificial intelligence to offer cheaper, more efficient insurance solutions, taking market share away from traditional insurers like Geico. Similarly, Berkshire Hathaway's investments in railroads, particularly Burlington Northern Santa Fe, BNSF, could be vulnerable as transportation trends shift towards more sustainable and digital alternatives. The global push toward electric vehicles, as well as increased investments in alternative transportation methods, such as hyperloop systems, could decrease the demand for traditional rail services in the long run. While BNSF still holds significant value, it is clear that traditional modes of transportation are being overshadowed by new. Berkshire Hathaway's exposure to these traditional industries, combined with its heavy reliance on a few key investments, suggests that Buffett's approach to diversification may not be as effective in today's rapidly changing world. The world is moving away from traditional industries, and it's unclear whether Berkshire Hathaway can adapt quickly enough to maintain its competitive edge. Number 4. A new generation of investors. The rise of a new generation of investors, particularly millennials and Gen Z, has introduced a new wave of thinking when it comes to finance. These younger investors, who grew up in the digital age, have a very different approach to money than previous generations. For many, investing is not about patiently waiting for long-term gains. It's about taking advantage of short-term opportunities, leveraging digital tools, and being part of the broader conversation happening on social media. Number 5. The rise of alternative assets. The financial landscape is undergoing a significant transformation, with alternative assets increasingly gaining prominence. Traditionally, the stock market, bonds, and other publicly traded securities were the go-to investments for long-term wealth creation. For Warren Buffett, the focus has primarily been on stocks, especially those of companies with strong fundamentals and clear long-term growth potential. However, the modern investment world is expanding far beyond these traditional asset classes. Today, investors are diversifying into various alternative assets, such as private equity, venture capital, real estate, commodities, and more recently, digital assets like cryptocurrencies. Cryptocurrencies, for example, have emerged as a particularly polarizing asset class. Digital currencies like Bitcoin, Ethereum, and other altcoins have attracted both institutional and retail investors. While Buffett has famously dismissed Bitcoin as rat poison squared and has remained highly skeptical of cryptocurrencies in general, their rise cannot be ignored. Over the past decade, cryptocurrencies have grown from niche investments to significant players in the global financial system. Major institutional investors, including hedge funds and corporations like Tesla and MicroStrategy, have made large investments in Bitcoin, believing that it can serve as a store of value or hedge against inflation. Furthermore, decentralized finance, DeFi, has also risen to prominence, promising to democratize financial services, making banking and lending more accessible, and removing the need for traditional intermediaries. On top of this, the venture capital and private equity sectors have seen explosive growth. Firms are now investing early in high-growth tech startups like Uber, Airbnb, and SpaceX. These companies were able to raise billions in private markets before making their way to the stock market. This has allowed investors to secure early access to companies that can yield significant returns. Unlike Buffett's typical investments, which focus on undervalued public companies with predictable earnings, these newer asset classes are often high risk and require a different skill set to navigate successfully. Real estate, historically a safe haven for conservative investors, has also become an increasingly attractive option. This asset class not only provides the opportunity for capital appreciation, but also offers consistent cash flow through rental income. For many investors today, real estate is seen as a tangible and stable investment, especially in rapidly growing urban centers and high-demand residential areas. However, Buffett has often avoided direct investments in real estate, seeing them as more difficult to scale and manage compared to his preferred stock investments. As younger investors look for alternative ways to build wealth, often through platforms like Fundrise or Realty Mogul, real estate is poised to be a central part of their portfolios. As these alternative assets continue to outperform traditional equity markets, Buffett's reluctance to fully embrace them could potentially leave him behind in the coming years. It will be interesting to see how Berkshire Hathaway evolves in this new landscape, especially when it comes to incorporating alternative assets into its broader strategy. Number 6. The impact of globalization and geopolitical risks. Buffett's investment strategy has historically relied on the stability of markets, especially those in the US, which for many decades were seen as the global financial backbone. However, the financial world today is vastly more interconnected and volatile, with globalization and geopolitical risks playing a crucial role in shaping the fortunes of even the most stable companies. The interconnectedness of global markets means that a financial crisis in one part of the world can have ripple effects across the globe. Buffett's investments in companies like Coca-Cola, Apple, and American Express are tied not only to the performance of the U.S. economy, but also to global economic conditions. Globalization has resulted in a complex web of trade relationships, supply chains, and regulatory environments. As businesses operate across borders, they are increasingly vulnerable to international trade conflicts, political instability, and shifting regulatory standards. The US-China trade war is a prime example of how geopolitical tensions can significantly impact the financial markets. While companies like Apple depend on China for manufacturing, they also rely on Chinese consumers for sales. Therefore, tariffs, sanctions, and trade restrictions can directly affect profits. Similarly, companies that rely on global supply chains, such as automobile manufacturers and tech giants, face supply chain disruptions due to trade policies or political instability in regions like Eastern Europe or the Middle East. Moreover, the rise of nationalism and protectionism across various countries poses a challenge to companies that operate globally. Nationalist leaders advocating for America First policies, for instance, may lead to more stringent trade restrictions and tariffs that could directly hurt international operations. This is a significant risk for companies like Berkshire Hathaway, which holds stakes in global companies, including those involved in industries such as energy, insurance, and consumer products. Furthermore, the increasing urgency of climate change presents new geopolitical risks. Natural disasters, shifting weather patterns, and new environmental regulations are having a direct impact on industries like agriculture, real estate, and energy. Berkshire Hathaway, with its extensive investments in insurance, could face mounting claims from weather-related events as climate change accelerates. Companies in sectors like utilities and transportation, which are heavily regulated and reliant on fossil fuels, may also find themselves vulnerable to policy changes and the push for cleaner, more sustainable practices. As globalization continues to shape the future of investment, Buffett's traditional strategy of buying companies based on their predictable earnings and strong fundamentals may not always hold. Global political shifts, climate change, and trade disputes could make it harder for companies to maintain the kind of stability that Buffett has always valued. The world is becoming increasingly uncertain, and the financial markets will need to adapt to the new geopolitical reality in ways that may challenge Buffett's core investing principles. Number 7. The evolution of the fintech industry. Over the past decade, the financial technology, fintech industry, has emerged as one of the most transformative forces in the financial world. Fintech, which encompasses a wide range of innovations that apply technology to enhance or automate financial services, has completely reshaped how consumers and businesses manage, invest, and move money. For investors like Warren Buffett, this shift represents both a challenge and an opportunity, as the traditional models of banking and finance are rapidly being disrupted by technology-driven alternatives. Buffett has always favored investing in companies that provide services with clear business models and sustainable profits. This is why his investments in traditional financial services firms such as Wells Fargo, American Express, and Goldman Sachs made sense. These institutions were established, profitable, and had long track records of success. However, as the fintech industry continues to expand, these established firms are facing stiff competition from younger, more nimble startups that are rewriting the rules of finance. One of the key drivers of fintech's rise has been the increasing digitalization of financial services. In the past, managing finances, whether through saving, investing, or borrowing, required physical interactions with financial institutions like banks or brokers. Today, much of this can be done with just a few taps on a smartphone. Companies like PayPal, Square, and Stripe have transformed how people make payments, offer peer-to-peer transfers, and manage transactions in both personal and business settings. These companies have capitalized on the fact that consumers are increasingly seeking more efficient, less costly alternatives to traditional banking. For instance, PayPal's acquisition of Venmo in 2014 signified its commitment to tapping into the growing mobile payments space, particularly among younger consumers who are looking for fast, easy, and low-cost ways to send money to friends and family. Square, led by Twitter co-founder Jack Dorsey, has expanded its services beyond point-of-sale systems to include business loans, cash transfers, and even a popular investment service through its Cash App. These companies don't just provide one service, they're creating ecosystems where users can manage their entire financial lives, from payments to investments to loans. The disruptive impact of fintech is particularly evident in the rise of neobanks, digital-only banks that operate entirely online, without the need for physical branches. Neobanks, such as Chime, Revolut, and Monzo, have attracted millions of customers by offering high-yield savings accounts, low-cost international money transfers, and fee-free banking with no minimum balances. These banks are particularly appealing to younger generations who are disillusioned with the fees and bureaucracy of traditional banking. They operate on slim margins, but capitalize on their ability to provide faster, more efficient service than conventional banks, using advanced algorithms to lower operational costs. For traditional investors like Buffett, the allure of fintech companies lies in their scalability. These firms are able to expand quickly and globally, especially through the use of technology. Square's Cash App, for example, not only facilitates payments, but has expanded into other services like cryptocurrency trading. As the fintech space continues to innovate, it's clear that companies which understand the nuances of digital finance, along with changing consumer behavior, are in prime positions for future growth. For Buffett, who has generally avoided investing in tech-heavy sectors, this presents a dilemma. Should he adapt to the rise of fintech, or should he remain loyal to his tried and tested model of investing in stable, well-established companies with tangible products and services? Despite his skepticism, it is undeniable that fintech is here to stay. One of the most dramatic shifts in recent years has been the rise of cryptocurrency and blockchain technology. Cryptocurrencies like Bitcoin and Ethereum have transformed the way people think about money, providing an alternative to traditional banking systems. While Buffett has openly criticized Bitcoin, calling it a mirage and a bubble, the underlying blockchain technology has begun to attract broader institutional interest. Blockchain allows for decentralized, secure, and transparent transactions without the need for intermediaries like banks. This technology underpins cryptocurrencies and has found applications in a wide variety of sectors beyond just finance. From supply chain management to healthcare, blockchain has the potential to disrupt industries that rely on intermediaries to verify transactions or track data. As major financial institutions like JP Morgan, Goldman Sachs, and even the Bank of New York Mellon explore the potential of blockchain, it becomes increasingly clear that this technology will have a significant impact on the future of finance. However, Buffett's traditional approach to investing in companies with strong, predictable earnings rather than speculative assets has made it difficult for him to embrace the growing role of digital currencies. Cryptocurrencies have no intrinsic value in the traditional sense. They aren't backed by a physical asset like gold or silver, and their prices are highly volatile. This volatility makes it hard for Buffett, who prides himself on his ability to value companies based on stable and consistent earnings, to justify an investment in digital currencies. Yet, the rise of institutional investments in cryptocurrencies is hard to ignore. Companies like MicroStrategy, Tesla, and Galaxy Digital are betting on Bitcoin as a store of value, and many investors see the digital currency as a hedge against inflation and economic instability. But it's not just cryptocurrencies that are transforming the financial landscape. The rise of decentralized finance, DeFi, is equally important. DeFi refers to the creation of financial services that are not controlled by centralized financial institutions like banks or insurance companies. These services are built on blockchain technology, enabling users to lend, borrow, and trade digital assets directly with one another through smart contracts. Platforms like Uniswap and Compound allow users to participate in lending and borrowing activities without involving traditional banks, which typically charge fees for their services. The implications of DeFi are enormous. Traditional financial institutions like banks, insurers, and investment firms could see their business models upended by these decentralized platforms. Additionally, the traditional notion of credit scores, collateral, and loans may be challenged by the rise of decentralized lending platforms that use blockchain to secure transactions. For Buffett, who has invested in a variety of financial services over his career, the rise of DeFi could be both a threat and an opportunity. If these technologies continue to grow, They could force financial institutions to adapt or risk losing relevance. While Buffett's avoidance of technology stocks has served him well in the past, the continued rise of fintech and DeFi presents a new challenge. Investors who are willing to embrace these technologies are likely to reap significant rewards. Yet, Buffett's conservative approach, centered on the stability of well-established companies, has left him behind on some of the largest technological shifts of the 21st century. This reluctance to fully embrace fintech, cryptocurrency, and blockchain technology could mean that his empire may struggle to keep pace with the next generation of investors who are increasingly interested in digital-first financial platforms. For Buffett, the question remains: can he continue to stick to his tried-and-true investment philosophy, or will he need to adapt to the changing times and embrace the innovations brought about by fintech, cryptocurrencies, and decentralized finance? The future of finance is undoubtedly digital, and it remains to be seen whether Buffett's traditional value investing principles can coexist with the future of fintech and blockchain technology. In the coming years, the evolution of fintech will continue to challenge even the most successful investors in the world, and it's up to Buffett to decide whether he'll adapt or be left behind. And there you have it, Warren Buffett's investment empire facing challenges from the rapidly changing financial world. As we've explored, the rise of alternative assets, fintech, globalization, and emerging technologies is reshaping the landscape of investing. The question is, will Buffett's approach continue to work, or will he have to evolve with the times? If you found this video insightful, don't forget to like and share it with others who are interested in the world of finance and investing. And if you're new to the channel, make sure to subscribe and hit the notification bell so you never miss an update. We're bringing you more deep dives, financial analysis, and strategies that will help you navigate the ever-changing world of investments. Thanks for watching, and we'll see you in the next video. Subscribe now, and let's continue learning and growing together in the world of finance.